2022. My name is Christy and welcome to this exciting panel. The title of today's discussion is called Indonesia, the Key to Generating Alpha for VCs in Southeast Asia. I have two guests to discuss this topic with me. First off, we have Jeffrey Zhou, co-founder and general partner at Alpha JWC Partners, and Adrian Lee, managing partner and founder of AC Ventures. This session is 45 minutes long. If at any time you have any question for any of my fellow panelists, please feel free to type them in the chat box in your screen and we'll try to get those straight to them as soon as we can. So welcome, first of all, Jeffrey and Adrian to this session. We're very, very pleased to have you with us.
Likewise.
Hi, Christy. Good having us. Thanks for having us.
Yes. Maybe first question, we're going to start off with, we're just discussing very briefly about this, off cam. I want to touch on an article that just came out just last night or this morning rather by The Information. And it's actually about Tiger Global. The article was about how Tiger Global now is looking to raise $1 billion to invest in seed funds, globally. Obviously we've seen Tiger Global make a significant impact on the region this last year, but I just wanted some broad observations, of how you guys have been looking at the likes of Tiger Global entering the market in the last year. What kind of impact have they had on the Indonesian ecosystem?
Happy to start if that's, okay. Sure. So, I think it's great that blue chip investors like Tiger, DST, and so on are investing in Indonesia and Southeast Asia. I think it's a great endorsement of the type of investment opportunities that we have here. And they bring things like capital depth. We talked about in the past of having different gaps in kind of the capital chain, and it's Series B and Series C. And now with the likes of Tiger stepping in, we have all the way up to pre-IPO and even post-IPO capital that's focused on this part of the world. So I think from a capital depth standpoint, it's certainly really been beneficial to the ecosystem. I think the second thing is, if you look at Tiger's investment strategy around the world, they've tended to back similar models in all the kind of emerging markets. And in doing so, and they back typically what they see as the leaders of each of those categories, they can actually facilitate a lot of knowledge transfer between those companies. Some companies, say in India, may be more progressed than Indonesia. And so facilitating that knowledge transfer can help local founders here grow their companies faster. I would say the last thing is, again, given a fund like Tiger, where they also have exposure public and with late stage companies as well, is they're bringing a new, I'd say, knowledge and network and an understanding of potential exit opportunities to these companies. We've often spoken about what is missing from the Indonesian Southeast Asian landscape is more opportunities to exit, be it through IPO or M&A and otherwise. And probably the likes of Tiger has additional experience here, which they can also help.
Yeah. So maybe if I can add, so completely agree with Adrian, and maybe if I can give a different perspective, a different lens to this. We at Alpha JWC always say that the Indonesian digital ecosystem is still early. Yeah, both of us, we started at the same time, Adrian, right, in 2015, yes. and we are still in the early innings. What we saw in the new capital like Tiger coming in, it's expected. And if I can maybe give a prediction, in the future there will even be more. So there are certain capital that haven't been here yet. And I've always faced this to a lot of external investors, especially foreign investors, that Indonesia is not the largest market, right? We have other markets in the world that are bigger than us. But one good thing about Indonesia and also Southeast Asia market is it's a very healthy market whereby the dynamic of demand and supply, in this case, the capital and also the startups or the founders are actually less competitive compared to some of the bigger markets like maybe India or China or even US. So for that matter, we actually think that first of all, not many local Indonesia-focused fund like us, like ACV and Alpha JWC Ventures, and we expect more and more foreign and global funds to come in as well. And with them coming in, the dynamics is still very healthy, right? We always think about those investors like they might be here for a long term, but some of them might be here for periodically, right? But for us, we are always here in the region in Indonesia. Yeah, so it's good for the ecosystem definitely, and to be honest, we expect to see more and more capital coming in, especially when the ecosystem is getting more mature.
What kind of impact does this have on valuations as a whole, especially given the rise of Tiger and some of these other US investors entering the market in the last year? Because most investors I speak to, I guess it depends who you speak to, but have always kind of pointed out the fact that Indonesian valuations are overheated, and you're talking now about US investors who have sums of capital that a lot of VC investors here do not have. Have you seen the kind of overheating that everyone seems to be suggesting that they are seeing in terms of deals in the Indonesian market, and what does this mean moving forward?
I think that it's important to recognize there are different segments of the market as well, right? From with Alpha and ourselves, we tend to look at the early stage, and we're not competing with these global kind of deep-pocketed investors. In fact, we work very closely with the likes of Tiger and other global late-stage investors. They don't have the on-the-ground presence and capabilities to source, and actually it doesn't fit their investment mandate as well, to be doing companies which are at an early stage, sometimes pre-product market fit. But once they reach that market fit and they are able to take on the type of capital that makes sense for the likes of Tiger to deploy in order to scale their operations, then we work closely together with these types of funds, because we become a sort of local partner to them and bring them on board. I think that has become especially important during COVID, because people can't fly around the world like they used to. And in fact, I feel that some of these global funds have become even better partners, because it doesn't start with just kind of showing everything downstream to larger investors down the road. It starts with a relationship. And investors like ourselves and like Alpha, I'm sure we have actively reached out to such investors like Tiger to learn about what are the trends they are seeing in other countries, what are the companies that they have backed, for example, that have achieved scale. Oftentimes we have similar companies at an earlier stage. So there is a two-way relationship there of just knowledge transfer and also partnership in capital. I think just the other comment on your on valuations is that I would say on the late stage, if you go back 6 months prior, there has probably been some inflation of the valuations at that later stage. You've seen that not just from the likes of Tiger, but from I think you're essentially opening up a pool, a very limited pool now, a selective number of companies which have kind of reached that scale, that it now has access to a global supply pool of capital. And so the competitive dynamics naturally would have driven those prices slightly higher. I think with what's happened in the public markets, that has now started to take meaningful haircuts. You're seeing things of 20-30% reductions in maybe similar deals, and even kind of slower deal making in that late stage. But on the early stage, I would say that valuations for great companies continue to be as attractive as they were before. I remember the 5-6 years ago when we started, you could still see a Y Combinator type company at 8 or 10 pre, right, for example. And actually you'll still see that in this part of the world today. So that has not changed. I think what have changed in the kind of the 12-month time period was that later stage valuation.
Yeah, I also agree on that. And we always think that for us, Alpha JWC, and I'm sure with ACB as well, we are usually the first institutional investors in the cap table, and we have the responsibility to set the price. If we set the price high, then it's like a ripple effect, right? If we set 50% higher, and then the subsequent round will also follow that the same suit. So for us, we have been investing quite a lot in the past 1 year. I think in the past 1 year we have invested in 20 plus companies. Do we see an increase in valuation in general? Yes, but that's for the right reason. The valuation now compared to 5 years ago, now is definitely higher, right? And then the reason why is because the ecosystem is more mature. For example, the companies that we are seeing now, there's more companies that are profitable in the first 3 years, or at least in the CM2 level. CM2 is after the COGS, after logistics, excluding marketing. We are seeing quite a lot of companies that can reach that CM2 level positive pretty quickly. And the reason why is because the market has been educated enough. The market has matured, has been more mature, right? The infrastructure is already there. The internet penetration, internet connectivity is there. So I think the valuation should go higher going forward. Because why? Because when the market is more mature, valuation will be higher because everything will be quicker. But hopefully, the exit also will be faster. Yeah. So everything will be faster, and then I think this is good for the ecosystem. Why? Because the LPs are expecting, if an LP investing in the US, they know pretty much, okay, how long will it take from seed until IPO, right? Whether it's 7 years or 10 years, but there's a lot of data points there. In Indonesia, we haven't really seen that, but we are about to see some of the early examples of that, and that gives the LP, the investors, much more confidence about how this startup will play out in the future, and the predictability. I think is really important for the market.
But do you think it's going to be more and more challenging to justify to your LPs, the fact that, yes, you're an early stage investor in Indonesia, you did have, first in the money, first into the deals for some of the earlier, unicorns in your slightly earlier portfolios, or like moving forward with the likes of Tiger, who are not just putting in larger sums of money, they're also moving faster than many of the other VC players that we see in the market today. Is it going to be more and more challenging to justify to your LPs that, in terms of your value add in Southeast Asia, if, essentially founders just need the money to go, and they might easily edge someone like yourself off the cap table?
I don't think so. There's always, I've never found a founder that do not appreciate the local VCs, right? Usually in the early stage, local VCs needed. And by the way, there are not many local VCs out there, right, Christy? I mean, there's only a handful of us. And I mean, we are not competing with these global funds. The expertise that we have, some of the global investors might not be familiar with the market, might not have the connection with the talents, the governments, the businesses, right? So there's a tangible value that we are giving to these founders, especially on the early stage.
Yeah, I would say actually, Christy, if the likes of a global investor came across an opportunity without a local investor on board, they're probably thinking, why is it that there is no local investor backing this company? And why am I the one looking at this company when no one who is really close to the market in there already? So first of all, to kind of re-emphasize that point, we're not competing, and it wouldn't also make sense for a $10 billion fund to be doing early stage direct into Indonesia. The other thing is, I would say that some of us, most of actually the VCs here, we've been founders and entrepreneurs ourselves, right? So we can really sit, in the shoes of an entrepreneur and say, having been there, it's not all just about capital, right? And especially in markets like Indonesia, where you can have a significant development in the portfolio company through helping on talent. Everyone says talent is such an important challenge out here, right? And if you can help on talent, if you can help on regulatory, if you can help on BD, and of course, with downstream financing as well later on, that is real tangible value add. And I think for the likes of us, again, I don't want to speak for Alpha, but I know they do very well on this as well. We've built dedicated value creation teams that go in and work with the portfolio on all of these aspects. We hire in-house within the venture fund functional experts to support our portfolio in these areas, right? Because we know that what it's like to be an entrepreneur dealing with 100 things at once, and we want to be able to help in those pivotal things that can create value for them. And this is possible because we're locally focused and locally based. It's much harder to do this on a global scale or even on a regional scale.
Keeping in line with the topic of valuations, both of you also closed funds that were much larger than expected or anticipated rather. I think with AC, you guys closed your fund 3 at 205 and your original target was 80, and Alpha you closed at around 430 when your original target was 250. Obviously, managing a larger fund size comes with its own sets of unique challenges. I was wondering if you could take us through some of the considerations you had when closing some of these upsized funds and how you plan to manage those internally at the firm.
For us, I think one thing to understand is I think the pandemic, as Jeff had mentioned, really drove forward digitization and the size and scale of the opportunity. And we saw that in our portfolio with the rates of traction metrics and retention metrics and adoption metrics. So with that and with that faster growth, the larger fund was actually right-sized. So with the larger fund, it means that we can follow on and defend the ownership that we have in those best and most promising companies better. And actually, we feel that in today's time, a fund of this size actually works better in delivering the returns for our investors as well, and also provides deeper capital support to the founders. As you know, it matters not just which companies you are in, but also the ownership that you have in those companies, because ultimately the best ones, you need that ownership to drive those returns. But without the capital base to be able to continue supporting those best companies, then that ownership gets diluted significantly, right? And may not be material and meaningful for the fund by the time an exit comes around. So we were very fortunate that we were beneficiaries both of the traction those portfolio companies were getting, and also the attention that LPs had in coming in, seeing our portfolio, and also coming into the fund.
Yeah. So for us, the most important question is, can we deliver a good return for our investors with this fund size, right? And then where will we deploy? So the answer to that is, number one, what we are seeing in the market, especially in the past 1 year, the velocity of deals, the number of founders and startups coming to the market has increased quite significantly. And if you ask me what is the reason of that increment, it is because of the maturity of some of the startups, the unicorns, more accurately the decacorns, right? The one that's listed, Grab, Bukalapak, and soon is going to be Goto. Yeah. So these they have a lot of teams that are spun up from these decacorns and building startups. And there are so when we have seen a lot of decacorns listed, it really gives quite a liquidity in the market. And that's why we are seeing the next generation of founders. So we are seeing not only better quality of founding team now, but also more quantity of the startups and founders coming to the market. So the pipeline is getting healthier. And secondly, we understand that there are more capital coming to the market, but it's also important for us to be able to keep supporting these founders. We saw from the Fund 1 and Fund 2, which was started back in 2015-16, that we actually still have capability, or we still have a good opportunity to keep backing the great companies, right? So a combination of that is actually justified the size that we are raising, and the market is also growing as well. And I think it's quite natural for the funds to grow with the market.
Yeah. Keeping in line with that, you mentioned about velocity of deals that that's obviously picked up in the last, year or so. How are both of your firms kind of structuring yourselves to keep up with this velocity of deals that is, going to increase and keep increasing as we move forward? And second is in terms of portfolio construction, just coming off what you mentioned about, managing larger funds. And obviously, a lot of these startups are going to stay in the private market longer and longer, right? What does this mean for follow-on capital? Does this mean that moving forward, you guys will have to set aside more follow-on capital and perhaps take on more concentrated bets on companies that you think are really going to do well, or while keeping up with the ever-growing number of deals that is in the market? How do you kind of see that internally and structure your organization in such a way that you're able to capture both ends?
I think that's a great question, Christy. I would caveat that with more opportunities, we continue to be just as or even more selective on what are the opportunities that we want to get into. We like to back, we have a kind of a matrix that we like to look for across different market opportunities, different founder profiles, and different stages as well within that early stage bucket. And so I think we continue to adhere very closely to both not only our portfolio construction, but also to our investment mandate, and stick to what has worked very well in the past funds and continue to refine that as we do our upcoming fund. Now, to your question about how do we obviously rise up in order to meet this new demand. Of course, we're looking at continuing to expand our team. We expect actually to grow our team size by over 50% this year alone, and largely with team based in Jakarta, though we also now have teams in Singapore as well. And that is happening kind of across our firm, everywhere from bringing on senior talent, as DealStreet had covered with Helen Wong joining us, a veteran VC with 20 plus years of experience in China, and really huge value to portfolio companies out here, bringing that type of experience on board to be able to do deals. But also within our investment team, bringing on new analysts, training them up, and promoting those who are existing in the team. It also means investing into our, as I mentioned, further into the value creation team, right? Having more hands on deck to be able to work with those portfolio companies which we are backing. And I think it's scalable because we have that country focus, right? All the networks that we build, the resources that we bring to bear, because they have that commonality of country focus, it's easier to scale that across the portfolio.
Yeah. So for us, we have about 10 plus investment team in Indonesia, and even with that, with the velocity, we are still working super hard, right? I think what's important for us is the understanding of the landscape, both locally and also regionally and globally. So that allows us to move quicker because, of course, we are seeing the trends, understanding the trend inside and also outside Indonesia. Understanding of the market allows us to make a decision quicker and not also to be FOMO on some of the newer segments or industries, right? So that is one. But yeah, I mean, there's no shortcut to this. There's a lot of so every year we look at 1,000 plus deals. I think the past 1 year that is easily more than 2,000. And maybe in 2022 we are seeing 2,000 to 2,500, right? And it's definitely a very active market now. Understand that the global market, the public market has a lot of pressure, but at least in the early stage we are seeing a good fundamental, good founders, good team, and a very active market.
Let's talk a little bit. Oops, sorry.
Sorry, Christy. I was just, one thing I would add is that, we continue with that portfolio construction to ensure that we are not backing more companies than we know we can handle, right? I think it's important for us that, partners work closely with our founders along with the support of the team. We know partners in general can handle 10 to 12 companies per time, right? And in that way, we wouldn't compromise on what we can offer to the founders simply with more opportunities, right? So we need to, as Beth also said, grow the team in kind of many areas of the ranks in order to always deliver on that promise to the founders.
Okay. Yeah, just moving on, let's just talk a little bit about IPO markets. Last year we saw two very large IPOs, Grab as well as Bukalapak. Fast forward a couple months now, some of those stocks are not doing very well. Although I would say, I think broadly most tech firms have also followed through the same trends and have been on the downhill trajectory. I was just wondering what this means in terms of IPO pipeline as well as exit pipeline for your own portfolio companies.
So I'd say first, commenting, on kind of the market cycles. The market has had cycles, will continue to have cycles. There'll be ups and downs, right? But with our portfolio and even in public markets, I think if you look truly to the long term, then those will even out, and if you're backing the best companies, you'll make attractive returns. For Bukalapak and Grab, they did well in terms of their IPO raise. They priced it at a high point. There was minimal dilution, I guess, to the company as they raised that capital. And now they have immense amounts of capital in order to continue to execute and grow, build their businesses. So, I think it's been good for those companies. And I think for investors who look at the long term, as long as they continue to execute, then it should be good for the investors too. Maybe not so much for people who are looking to trade from buying and then selling immediately. But I think for at least for what we're doing here, it's really investing for the long term. What does it mean for companies going forward? We have I think at least a couple of companies which are in our portfolio that are looking to IPO either this year or maybe next. I think they are continuing to work on their plans. They will of course take the overall market situation into context and see what makes most sense for the company itself and the capital markets at the time. But they haven't made firm decisions to put off until next year or to stop the process of doing an IPO.
Yeah, and I think a lot of us will agree if I say that 2021 is a great year for at least for technology industry, right? And a lot of people also think that and feel that the valuation is on the high side. So I believe what we are seeing, the correction that we are seeing this year, I think a lot of people have expected that. And what is the impact to Indonesia, to the early stage? To be honest, when we value the early stage companies, we also benchmark it with the listed companies, right? And then when we compare it to last year's numbers, to be honest, we don't use that in our calculation because that is pretty high, right? So now I think the market is going to the level that's more reasonable, which is good, which is healthy. Is there any negative impact to the early stage? Maybe not. Is there any impact to growth stage? Maybe yes, because of course in the growth stage, in the later stage, the valuation is closely linked to the public market. There might be an adjustment there, but I think what's important is what are we seeing in terms of the fundamental, both in the micro and macro, right? The fundamental of micro, meaning the companies. Like I mentioned earlier, a lot of companies have strong fundamentals, strong unit economics. Some of the companies are profitable, so it's strong, right? And in terms of the macro, what are we seeing? Like what Irene mentioned, that these unicorns, these decacorns, right? They are listed and they get a lot of capital, and I can say that it's good for the company, it's good for the business. C Group when they were listed a few years ago or earlier. The stock went down first, right? And then they went up like crazy. Of course, there's a correction. So I would say that short term, there's always volatility. It can be overshoot up or down, but long term is still very much intact. The fundamental is still very strong. I would say it's not only very strong, but it's getting even stronger.
But you say that most of these growth stage firms are, have sound fundamentals. I mean, even if you look at C Group, which has been in a public market for a long time, obviously a stock has gone through ups and now is down. And some of these companies are still not profitable yet. Grab is another good example of this. I would argue that most of the growth stage unicorns, so those valued 500 million and above, and unicorns, a good chunk of them have not yet reached the kind of profitability that maybe some of retail investors or some more conservative investors will be hoping that they would be at. So if that's the case, then what is this going to mean? I mean, a couple of people I've spoken to have mentioned that, some of them may even look into delaying their IPOs. Could we see a bit more of a wait and see attitude when it comes to going to the IPO market or no?
I think the companies that we have, visibility directly to on the growth stage, they are very well capitalized. And, if they've got a ton of capital sitting kind of on their balance sheets, the purpose of that is to grow the team, grow the business. And they can have strong unit economics on the, on the GP side, on the CM 1, 2, 3 side, but they don't need to be making a net profit because that's not what they raise capital for. They raise capital to grow the business and to get to number 1, number 2 within their industry, and that's what's going to drive the outsized returns. So I think yes, maybe they will. They don't need to go to IPO so soon if it's not the right timing. There is always an option there to pull in more capital if the capital markets are amenable to that, but there's no urgent need to have to do that. I think that's the difference.
Yeah, and if I can add, so let's take these two examples of the one that has listed and the one that's coming to list, right? So the one that's listed, we understand that they're not profitable yet, but like what Adrian mentioned, that we are still in a growing market. And I think a part of why the market perceives and maybe price them as such currently at a lower price compared to the IPO is because they expected profitability. But to be honest, some of these companies are still very much in the growth stage. Just to give you an example that I know personally, C Group has a Garena. This is a gaming company that's profitable. The e-commerce is still early in a lot of countries, right? And how about the fintech play? They just the digital bank. They just launched, right? I mean, do we expect them to be profitable in the next few years? Maybe not. But can they grow exponentially in the next few years? Definitely, right? So I think there might be a mismatch between the expectation of the market, whether it's profitable or it's growth, right? But of course, different investors have a different way to view this. But my point is that there's still a lot of potential for growth, especially in the emerging market. And I want to highlight the companies that we have that is the unicorns. So last year we have 4 unicorns in our portfolio. So we have Ajaib, we have Kopi Kenangan, Karo, and Kredito, right? And I can tell you, if they are, all of them have a very strong fundamentals, unit economics. Can they be profitable? Yes, they can be profitable right now if they stop growing, right? But again, it's not an easy thing to manage. Okay, should they continue to grow? Which definitely yes, but how to manage the investors' perception and also expectation for profitability. So I think getting the right when is the right time to list, who are the investors on board, right? Is also important. To make sure that there's a balance between getting the capital and also managing expectation on how much to grow and when to get profitable.
Talking about growth for companies as a whole, the unicorns and the unicorns that we know about in Indonesia, a good chunk of them are actually more B2C firms, just given the maturity of the market. But how do you kind of see 2022 shape up for them, considering that we're entering a season now where we are seeing rising inflation, there's high interest rates, all of these can potentially hurt or hit revenue targets for some of these Indonesian B2C firms. Do you think 2022 could be a time where, you may have to take more of a conservative look at in terms of growth targets?
I don't think so. We are still in a very Christy, I mean, the data. I mean, hopefully we will have we can publish some data about where we are in the digital economy, right? To grow double, any company to grow double is still, especially on the one that's in early or in the vertical that are not too crowded, right? It's still very possible. So the growth is still very much there. So when we think about the growth target, we are still early. We are still very early. And just to point out, like, we are watching the second tier cities closely. I believe in Indonesia, the internet economy is not yet fully penetrated to second tier cities. Yes, we have a lot of adoption in the first tier, right? But yeah, so there's a lot of source of growth over there. There's a lot of source of growth also coming from the ability to consume and to pay. This is from rising middle class. So there's a lot of there's a lot of structural reasons for Indonesian digital economy to keep growing, no matter whether it is inflation or whatnot, right? It's because we are still early and there's still a lot of room to grow.
I think if you look at the usage that happened during the pandemic, you not only had existing users increase frequency and basket size, but you also had new users pulled in, especially from the tier 2, tier 3 and rural areas, adopting online commerce and other formats as well, digital payments, and so on and so forth. So that change in behavior is very sticky, and it sets a perfect stage on which companies which have the capital to grow can now continue to push more growth within their kind of total usage. And so I think with when you look at the kind of total market size and see that penetration of e-commerce out of total retail and so on, that's barely over 10%, and you look at other countries around the world like China and more developed countries where that is far in excess of 20+%, then there's still so much more to be done in Indonesia, and hence it's I think, as Jeff had mentioned, kind of the structural and demographic tailwinds that you have here on digitization of every sector are so strong. Being able to grow double, triple, these are table stakes for companies which are executing well.
Do you think there's still a growth stage gap in the Indonesian market? I mean, I think just a few years ago we were talking about, how there's funding gap in, say, Series C, Series D. Earlier this morning, I think Nick Nash had also mentioned that he still feels that there is a funding gap. I don't know what some of your thoughts on that, whether or not the gap is still there, or you would anticipate new types of capital investors looking to kind of fill that gap at the moment.
Yeah.
I think Indonesia could always do with more capital, right? There's so much to be done here. If you were to compare how much capital Indonesia gets vis-a-vis China and India, even scaling, adjusting for relative market size, I think there's still a gap, right? So we can benefit from, we meaning the entire ecosystem can continue to benefit from smart capital going to the right companies that can help them grow. But I wouldn't go so far as to say there is a gap, right? At every stage, there are investors, and the best companies will attract those investors on board. But there can always be more, right? But I wouldn't go so far as to say now that there is an actual gap. If you reach a certain stage, you can't find an investor. If you can't find an investor, it's probably more about the company than the lack of investors.
Yeah, if I can add, I would say that now we are more confident that the capital will be available to our companies. So in the past 1 year, or even in the past 2 years, I would say that almost all of our portfolio companies who need capital get the capital. This can be from Series A, Series B, or even Series C, right? So, and of course, there's different pockets of capital, but I will really think that, is there any opportunity? Yes, but if there's any gap, if I have to choose yes and no, I will say no, there's no gap. I think we are pretty well covered.
Okay. Moving on into sticking actually with IPOs. I mean, we saw Bukalapak IPO in the Indonesian market last year. I mean, obviously, you guys were observing that whole process very closely. I was wondering if you could provide some comments in terms of where the Indonesian ecosystem is in terms of IPO preparedness. Are there any particular areas in which there are still gaps in the system, and what can be done to improve them?
Jeff, let me let you take that one first.
I think especially on IPO in Indonesia, there are more and more companies are looking into listing in Indonesia Stock Exchange, and this is the companies that are smaller in size compared to the one that's thinking about listing in the US, right? So this is good because why? Because not everyone can list at 20, 30, 40 billion dollars. Like Goto is actually going to list in Indonesia Stock Exchange, and their market cap is pretty large actually, right? So yes, it's possible, but my point is that there are few options. I think 3-4 years ago, we might not even have an option to list in the US, right? Or at least some of the companies are not that ready or not at that size yet. So now we have few options, and one thing to share is that Indonesian stock exchange are actually pretty friendly. It's pretty easy to list, assuming the company meet all the requirements. I think a lot of Indonesian companies are comfortable to list in Indonesia as well. There are a couple of companies in our portfolio considering about that. Of course, there's a lot of consideration, but the consideration is mostly on whether staying private versus public. But if, let's say, if they think that this is the right time to go public, I think they will do it, and we should expect to see more and more listed companies in the Indonesia Stock Exchange and also in the US in the coming years.
I guess what I would add to that is, if you look at the kind of top 10 companies around the world by top 20 companies by market cap, you'll find in other parts of the world you are predominantly dominated by, in more developed markets, it's dominated by technology. Maybe 70 to 80% of the market cap is tech. In Indonesia, it's still something like 20%, right? So there's a long ways to go in terms of the transformation of the digitization of market cap in the Indonesian Stock Exchange. And I think that is going to look vastly different. In fact, it's going to be flipped, right? Instead of 20%, it'll be 80%, in the next 10 years. And I think to your point about what needs to change, what's happening at the moment, I think the regulators have been very supportive. I think, as you know, my partner is also working with the IDX to help attract more technology startups and to make it easier to list. And they've done everything from like making dual share structures, streamlining licensing, tax incentives, and kind of adjusting admission policies, right, in order to be able to list. So I think all that continues to help. But maybe one of the aspects which is outside of the regulators' control, but will come over time, and I think both Alpha and ourselves, we've backed companies that can help this, is the emergence of digital brokerages, right? That are attracting a new class of investors. In fact, opening up stock market, public equity to the middle class, and opening up the opportunity to take part in public market returns to many more people than were historically possible with traditional brokerages. So with all of that coming together, I think that there is actually a lot of promise for technology listings in the Indonesian Stock Exchange in the years to come.
Yeah, keeping in line with that, I mean, do you still think there are significant barriers to entry for many of these potential retail investors in Indonesia?
I think financial literacy has still obviously some way to go. And being able to invest in the stock market is obviously a more sophisticated action, right? And even and then you're also still talking about underbanked and and unbanked even, right? Still, but there are technologies that for example, like Bibit, which we're investors in, that enable someone to simply not think about it, but just be able to park money automatically to get broader exposure to public equity. Sorry, Jeff, I cut you off a bit. Things like that can help.
Yeah, agree. But and I think there's the retail investors are getting more and more educated. There's always room for more education, but I think now there's not so much meaningful barriers. I think companies like Bibit or Ajaib, we back also Ajaib, is democratizing access to for these retail investors.
Okay, I think we've come to the end of this session. Thank you very much. I don't think we have any questions. Yeah, we don't have any questions for this panel. Thank you very much to my two fellow panelists, Jeffrey and Adrian. It was a very good discussion. I hope that all of you will join us again soon. Have a good afternoon.
Thank you so much, Chris.
Bye.